Hello and welcome to Chapter 4 of the Osborne Books Bookkeeping Controls book, Using Control Accounts. Now, this is quite a long chapter in the book, so I'm going to take some time today, but also as well, I think that this video is going to have a bit more of an advantage over the book in that I can animate it, so I'm going to take longer than the book, and I do think that this video in particular is probably more pretty important to be able to understand what's going on in this chapter, because you're going to have better diagrams because they're going to be animated. So what we're going to be doing is we're talking today about control accounts and what are they, or what's the purpose of them really. And if you remember at the start of this set of videos, I was saying that there was a series of principles going on that we were trying to achieve really, that we wanted things to be accurate. And so control accounts allow us to check figures. They're really sort of there as checking accounts. These control accounts appear within the general ledger, and I'll take you through the 5-stage accounting system soon as well. They allow us to check things, and they allow us to check things by comparing them to other pieces of information, things that have come in from outside. So a bit like in Chapter 3, where we had the bank reconciliation, and we could compare the figure in the cash book or the bank control account to a bank statement. Here we can start to use our control accounts and the ledgers that come off them. So the ledgers that actually are used to compare to the control accounts. We can compare the control accounts to the ledgers. We can compare the ledgers to external things like remittance advices. So we're going to see this kind of idea. We have this idea of timeliness, and this idea that I think, and there is, we will always make errors within our posting, within our accounting system. Nothing is going to be perfect. There will always be mistakes within there. The use of these control accounts and the splitting into separate ledgers that come off them allow these errors to be found faster. So it splits up the figures, and I'll take you through those in the diagrams of how that's going to be achieved. It allows us well to look at relevance. Instead of having one number that represents the whole figure, which will be, let's say, in the trial balance, the control account, we can also then split that figure up into smaller numbers, so we can have two different sets of numbers, all adding up to the same figure, but looking at being used for different things, and so it's more relevant in terms of providing us better information. Now, in terms of when you were doing the bookkeeping transactions unit, you might have been thinking, well, why were there so many books going on? There's books for this and books for that, returns and sales day books, purchase day books, and a whole series of them. Why was it that there were so many in there for each individual section? Well, the use of these control accounts, together with those day books and the separate ledgers as well, allows us to split up the finance department into several different units in there, all undertaken by different people. So what we can do is no one person can have complete control. So no one person can make a complete mess of it, but no one person is in a position really to complete a successful fraud unless either they collude with a whole series of other people, which is not really likely, or alternatively the control accounts aren't reconciled, which is how frauds tend to happen. Really, the control accounts aren't reconciled and checked. But in their theoretical and correct form, the use of control accounts and their separate ledgers that come off them allows the prevention of fraud. And it does it by this concept which I've put in, which is another new concept that I'm sort of introducing here. This idea of segregation of duties, this idea of splitting up the finance department, the sections and the actions within the finance department into different people, really, all fitting together in a very set out way there, but then that allows this idea of segregation of duties. It also as well practically allows the use of different levels of ability within a finance department. So certain people who just focus and specialize on, let's say, the sales invoices and posting those. Some people who might be doing the cash book, which is a bit more complicated. Some people who might do the individual correcting journal entries, which would be the professional accountant, let's say. It allows us to have an accounting department of different abilities without having to have specialized professional accountants doing everything. It also as well, and I'll explain how the book doesn't sort of allow this, but I'll explain how we're going through, how it will allow the finding of errors that could not be found solely internally. So we might have actually made a posting within our accounting system, and there is no way that internally we will be able to find this thing because it would add up correctly. It would be correctly posted in terms of a double entry bookkeeping perspective, but it's actually just wrong. And I'll show you how that happens when we get into the individual sections like the sales daybook and what have you. So those are the principles. Have those to one side. Useful to have when we're going through and we're going through the book. I'm then going to now take you through the book. So I'm going to give you a bit of a recap, going back first of all to the five-stage accounting system. And let's have a look. Is there anything in that? No, it's not in here. Anyway, so let's go through. It's not in the chapter, but I'm going to give you a recap of that because I think it will be quite helpful to sort of see how this all fits together. So let's just go through. So we've got a financial transaction. We've got some form of order. We've agreed some form of order or what have you. We've sent an order out. So we've made a financial document, but it's not produced a financial document that will go into a daybook yet. We've had some goods in, what have you. Or we've made a sale or what have you. Yeah, there's been goods received notes and goods delivered notes or delivery notes and what have you. We've still not got a transaction that's going to, a financial document that's going to hit a daybook yet. And now we get a financial document that's going to hit a daybook. Let's say it's a sales invoice. Okay, so we've got this financial document. It goes into, we post it into a book of prime entry. There, so either the sales, either a daybook or the cash book. Cash book, is a book of prime entry as well at the same time. So we've created this book of prime entry, and now where are we going to post it? Okay. We're going to post it in two ways. We're going to post it into our general ledger, and our general ledger includes the control accounts. So the general ledger is where we get our trial balance from, and that's where all of our figures are, all of our double entry bookkeeping is. And there, so it's going into there, and it's going into a control account in the general ledger. But also as well, we're putting it as another posting. So it's an additional posting, so not part of the double entry bookkeeping system. So not part of your double entry bookkeeping within the general ledger, but into another ledger, such as the purchase ledger or the sales ledger. Now, why is that going to happen? Because as you'll see later on, it'll allow us to split this big number up in the general ledger control account into a series of smaller numbers, so we can compare both the big number in the general ledger control account that we think, right, is that good or bad, and produce our financial statements from it. And also as well, we can compare the smaller numbers in these other ledgers and to see whether they make sense. And so then off our general ledger, we produce our trial balance. Now I'm going to add something extra in here which isn't in the book, that we produce our financial statements. So our financial statements produce from our trial balance as well. Now, we then have an external financial document, another one that's come in. So let's say we got our purchase daybook and our supplier sent us a sort of reminder, really, of what we owe them. We can compare it. There's no point in it. We can't compare it to anything in the general ledger control account. That's just a big number of what we owe all of our suppliers. But we have got this extra thing now in from outside, and we could compare it if we had a list of the individual balances on those suppliers to that figure and said, well, do we agree or do we not agree? We might have sent some goods back that they don't recognise because we thought they were faulty, or we might be in dispute over an invoice and we might not want to pay what they're saying that we owe them. So we can compare from that, and that idea of comparability is quite important. We might also have some other external financial documents, so like the bank statement, and we're going to compare those to our control accounts as well. So it might be a question that we get something in from the HM Customers and Excise that say, we believe you owe us this amount for our VAT, and we would compare it to what's in our VAT control account. Typically it goes the other way, but they may disagree and hit us with a penalty notice, let's say, that we haven't factored in. So we would have this idea, and this is quite important really, isn't it? That you can see this is, as a student initially you might think, well, why are we running with almost two sets of entries, the control accounts and the general ledger, on these other ledgers as well, and this posting of the same thing is going into both. Why is that happening? Well, actually, it might be that the double entry bookkeeping is coming into here, and often just one side of it is going into here. Why is that happening? Well, it's allowing us to do this comparison of certain external financial documents that don't go into the books of primary entry, but are more checking documents. Ones which we can check against the individual accounts for particular suppliers or customers, what have you, and ones that we can compare against the whole control account, like the bank statement. And it's that triangulation here. This is another concept I'm going to introduce here. This idea of triangulating pieces of external financial information, financial documents, against our internal information that allows us to have comfort that our figures are accurate. So that's why this approach is being taken, why it's being split up so much. It's allowing us to make decisions and also confirm accuracy. Okay, so that is a general run through of why, which should set up then the other diagrams now in the chapter. And I think this opening bit sort of helps then make the purpose of the control accounts a bit better, really, and you'll be able to also understand it a little bit more. Now, so we've got something now called the sales control account here. And before I go into it, I'm going to explain to you why we would have a sales control account. So we've got our accuracy and our comparability and our relevance. So we want to make sure that this figure that we have in the general ledger for our sales control, what we think the people owe us, the total amount of debtors. So if we're saying it's £100,000 worth that we're owed of our debtors, and we'll get that in over the next month. And so we can make this some kind of comfort and go out and buy a particular piece of machinery, because it's okay. Although that runs our cash down to a low amount, we've got to have another £100,000 coming in that we can use to pay the wages. We've got to make sure that that's accurate, that this debtor really exists, because quite often companies go out of business because what they say the debtors are don't materialise, and they run out of money. So is it accurate? And that accuracy also is, can we compare it to these external, what the supplier or what our customer thinks that it is? There's a relevance element as well. It's no good having figures if you can't take actions from them. So there's a particular thing we're going to do called aged debtors analysis, which is going to make this information very relevant to how things are going to work. And so we're making our actions making our information more relevant, and therefore being able to take action from them. So what do I want to see? Well, I want to see the overall debtors balance, and I'm going to get that from the general ledger in the control account. And why do I want to see that? Well, I have a general idea in my head as the reader of the accounts of what the overall debtors balance should be. Let's say I think it should be £50,000, and let's say I look at the general ledger, and it says that the control account says that it's £100,000 in total. So I'm now concerned. Okay? Why is it that we have got £50,000 more in our control account than I really think it should be? Is it because we have suddenly lost control over our debtors? We're no longer chasing them down, and you would be surprised how much that actually is in real life. I've seen that quite frequently. So is it that we've lost control over that? Is it that actually we've got an error in our system, that we have £50,000 worth of sales within our sales that actually were never really made? This invoice didn't exist. We don't have that. Is it that we've got a big problem with one of our debtors, or one or more of our debtors, and actually they are going bankrupt and they're not going to pay us? So I want to see the overall figure first, because I have a general idea about what I think I can support in terms of debtors, or what I think it should be. And often in terms of comparability, I compare it to the same point last year. And if it's different to that, I'm now concerned about something's going wrong. So remember, in terms of this idea of professional skepticism, I'm comparing the overall control account to something else. So I want this large figure. I want this big number. But I also want to see the individual debtor balances. Now this isn't something different. This isn't something, if we go back to this chart here, this is where the control account is in here. This is where the big number is, the total of it all. But this separate one, in this case the sales ledger, has the summary of all, well, has all of the individual amounts, the individual customer balances. I want to see those individual customer balances because I want to see if particular customers aren't paying on time. I want to see if particular customers represent a bad debt risk. I want to see which customers we're chasing. So remember, I want actions. The big figure in the control account is just telling me there's a problem, but it's not actually telling me what to do about it. It's just we've got a problem. The smaller numbers in the sales ledgers tell me where I've got a problem and what I'm going to do about it. Now you can't. Why don't we just then have a whole list of sales ledgers sitting in the general ledger? Why do away with the control account and just put the individual sales ledger balances in the general ledgers and call them all individual, debtor number 1, debtor number 2, and what have you? Well, the problem is that I can't get then a handle on this idea of, well, are we high or are we low in terms of our debtors, this £100,000 figure, unless I add them all up, and that takes time. And coming back to the timeliness concept, if I can set up my figures so that the information is already there, well then I've got it, it's faster, I'm making my decisions in a more timely manner. And so that's the reason why there's two of them, the large figure in the control account, the general ledger, and the smaller figures in the sales ledger, because it's simply faster to understand it and make decisions. It's also as well faster when we get through here. So let's say we'd done away with the sales ledger control account. We'd put all the individual balances as individual balances in the sales ledger account that are appearing in this trial balance. We'd now have to add them all together to produce the financial statements, and so that would take longer. So they go in a control account in here because it's faster to produce these and also gives you the overall position. They go in an individual ledger over here because that allows us to do the individual actions that we're going to do when we're following up. And so that's an important concept to understand why it is that we're doing this in separate amounts. So on the one hand, we're checking, does the control account match to the sales ledgers? Is it accurate from that point of view? I've been told that I've got £100,000 worth of debtors within my control account. Now, how does that make up in terms of my individual customers? When I'm looking through that, if I know that customer X never in a month of Sundays bought £50,000 worth of items with us because they were a small corner shop and they only ever bought £500 from us 2 years ago, I know we've posted something wrong. So I can match up my control account to my individual ledgers. I can see whether we have a problem, are debtors increasing as an overall, and I can take actions by looking at the individual debtors and looking at what's going on within those figures. I can either be comparing the external document that comes in from outside to their debtor balance in the sales ledger and see whether I've got an error. I can look at the age analysis, which I'll take you through in a minute, to see whether they're paying on time. So, how does this work? The day books are posted to the control account as a whole figure and to the ledger accounts as individual items. So I'm going to show you how this works. So we've got a day book here, and this I think is going to be better than the chart on, or the diagram on page 50. So on the diagram on page 50, you've got this sales invoices that has come into the sales day book. But here we've got a sales day book, and I put some numbers in. Right, so we've got a general ledger here. In the general ledger, I've got my control accounts, which for the sales day book, there are 3 of them that are relevant. The sales ledger control account. So the £600, there we go. I've got my general ledger, and I've got my sales ledger control account, and the £600 here. Well, it's what people owe us, so it's an asset, it's increasing, so it's a debit balance. The £600 was a debit going into there. I then got my VAT control account. Okay, so that's I've got my sales ledger control account, I've got a VAT control account. And the £120 is an amount that I owe to HM Customs and Excise. It's going up. It's something that I owe, so it's a liability that's going up, so it's a credit balance. So the 120 credit will be there. And I've got a third account, in my general ledger. It's not a control account. It's a statement account. It's the sales account. Now I've gone and followed the diagram on page 50 as the sales account. I think at level 2 actually you post this to equity. I don't think that you do what's known as profit and loss accounts yet. But this would be the sales account. What you would actually post it to would be the sales account, and that would be the sales that we produce, and it goes into what's known as the profit and loss account. So I've got the sales account in the general ledger, and I've got £480. Now, why is that a credit? Well, that's because all profits we owe to our shareholders. So all sales we owe to our shareholders. That shareholders are a liability. A liability that increases is a credit. Therefore, it is a credit. So that's how you would work it out. Now, what we also then have is we post the individual balances here, the amounts that these individual customers owe us, to a separate ledger called the sales ledger. So the £100 that customer X owes us goes into their sales ledger over here. The 200 goes into customer Y. The 300 goes into customer Z. Now you can see that these three figures here total this figure here. Now there's no double entry bookkeeping to this side here, because this is not part of the double entry bookkeeping system. This is the general ledger here, where there's the double entry bookkeeping, the debits and the credits equaling each other. This is another ledger, which is like an aid ledger, really. It's helping you understand this £600 here. It's broken down into those three there. So it's a breakdown of these big figures. That's what these other ledgers are here. This sales ledger, this purchase ledger. They're breakdowns of these big figures. So we can have this nice big figure here in the sales ledger, and well, in our general ledger. You know, what we're going to do to produce our trial balance. This idea, right? £600 is what we're owed. But who owns us? Who are we chasing? Well, you're chasing these three people for that amount. So you can see how it's quite efficient. It's given us both sides, the total figure and the individual breakdown, in a very efficient method. Okay, so that's the whole purpose of this. So what we'll go through, I'll run that through again. We've produced our sales daybook. Off that, we would have our sales ledger control account. The total amount that's owing to us goes into that from the sales daybook. We have our VAT control account. The amount that we owe VAT goes into that, and that's because we owe it. It's a credit. And we have the sales account, which is the profit and loss account. It's going to be equity actually for you at level 2, but I'll use what's on the diagram. And the 480 goes in there. The individual amounts that each of these individual customers owe us goes into their individual ledgers in their sales ledger. So general ledger, sales ledger, and the sales ledger total here, which totals £600, is the same as what's in here. So this doesn't form part of the trial balance in here. It's not £600 worth of debits here, £600 worth of debits here, and only £600 worth of credits. No, it's £600 worth of debits here, £600 worth of credits here. That's that all done. That's the double entry keeping booking done. The £600 worth of debits here is broken down like that. And that's how a control account works. Hopefully you can see what it's trying to do there. I'm going to show you how now this is we'll do this in more detail in the next chapter, but here's how the journal would be posted. I've gone old school on you here. I've actually put this into what's known as 8 column, which was how we used to do it in the good old days when we did this handwritten. I'm not that old. I'm only 45, but I was probably the last of the trainees that posted things by hand. So this is how you would have it on a piece of paper, 8 columns, and you would post it like that. It would slightly go across there. I'd write across there, but it's set out in 8 columns, and this is the efficient method to try and make sure that there's no mistakes. So you'll see how I've indented, and I've put my debit here and my credits here slightly indented apart. So I'm always remembering that those are debits and credits. I'd expect to see a debit balance against that dent in there. I'd expect to see credit balances against those ones there. Useful tip that. We'll probably see that that's not how it's done in the next chapter. Then I've got my debits here with my pounds and my pence. Now notice how there's the line in between in here, and that was how it used to be laid out on the paper. And notice how very neat. Okay, because it's in the computer, but if I was doing this by hand, which we used to, they would line up exactly, and this is to try and be able to add up and be accurate all the time, really. So that's how one would look. You'd have the date, you'd have the journal number as well, so you could always track it through, and we would be totaling like that and making sure our debits equals our credit. So that's how the journal would get posted to achieve this going into there, that going into there, and that going into there. That's what will actually go into the general ledger. Note how there is no journal going into the sales ledger. We're simply putting them in there. It's the sales day book that goes into the sales ledgers here, and the note against that would be sales day book date or whatever it would be, and they would be noted there. That's how you would do that. So it's the sales day book that would go into here. The journal will be prepared from the sales day book, and that would go into the general ledger. So the actual sales ledger here, these figures have there's no link between them. It's just simply that those happen to be the same amounts that they are, because they're coming from the same source, but they don't form part of the journal. Right, so the book then starts to sort of give you some ideas of the sales ledger control account, and so we've got some things here. So I'm just going to run through a sales ledger control account really with you. I've prepared one here. I put some numbers in, might make it a little bit easier, because so what I've got then is alright, so what I've done then is I'll go through the individual items. I got the brought forward balance. So this is the balance of the previous month. So what was brought forward in here. So I'm saying that the previous month, all of our totals of our debtors in our sales ledger equals £150. Whoever it is that's there. I've got my sales day book journal, and if you notice in my previous one, I numbered it. So I numbered it number 1. So I gave it a number, and that's come in, £600 there. I've got my cash book, and in my cash book I've received £400 worth. That will be coming in from the cash book, and I produce a journal for that. And now I've got some dishonoured checks. So in this cash received, well, actually £50 worth of it bounced. So I've got a dishonoured check. Now that means that customer didn't actually pay, so they owe us the money. So it's an asset that's increasing, so that will be a debit. Then I've got some discounts allowed, so I reduced the amount that the customer had to pay us by £50 because they paid early, let's say. I wrote off some debts. I said that a debtor didn't exist. I got a write-off of debts in here. So a write-off of debts is, well, actually we don't think that we're going to be able to recover the debt. Now what you will actually see in the sales ledger, which might be slightly different. I think I pointed it out in the previous one of the previous chapters. It's slightly different to what is in the book. Is if I go back to here, there would also in the sales ledger be a write-offs ledger, a provision for bad debts. In actual fact, it probably would be in the general ledger as a separate provision for bad debts. This wouldn't hit the sales ledger control account at all. So this here, I know it's been put in the sales ledger control account, this write-off of bad debts. Actually, in practice, and I must confess, when I'm not sure why it's in here either, there would be a separate account for the provision for bad debts. It's a provision for bad debts account, because you would still want to be leaving. If you wanted to get this to work in the way in which it's set out in the book, you would have, let's say it's this debtor that's been written off. We'd have to put a credit here, and we'd have to get that to 0, and we'd have to put a credit here, which would be £500, and then we would have £500 equaling £500. Well, we actually want to know that customer X still owes us £100 because they might want to come along and try and buy some more from us, or we might want to go and chase up their debt with their administrator. So we actually wouldn't want to put the write-off of bad debts here and here in the sales ledger control account. It would not appear there. It goes into the write-off of the provisions for bad debts accounts, which is a separate account within the general ledger. However, This is how the exam is set out, and this is how the books have been created. So you have now both answers about what you would see in real life. You're going to see a provisions for bad debts accounts, but in the exam you might see this write-off of bad debts figure that you've got to put in the sales ledger control account. I've got something called a set-off item. I'll take you through what's a set-off item separately in a bit. It's where basically we owe them some money as well. We owe one of these customers some money, £200 in this instance in here. So we have something called a set-off item where we both agree that we're not going to chase the other one for that £200. I'll explain to you why in a minute, but just at the moment consider that in this one to be a set-off item. Now, I do my T accounts like this. I think this is neater. Now, I do the total, then I work out what my carry forward position is, or the carry down within the book, and then I retotal it again. It's simply neater than having to try and put the difference in and do that. It's faster in terms of the accounts. I remember I used to do this when I trained and I had to do it properly for sets of companies, and so it's a faster way of doing it. Less chance of error. You'll get it more. You get it right more often. It's quicker to actually calculate, and it's quicker to produce. And then that goes there. Now remember, this is the figure that is in the general ledger. So in this instance, the figure is a debtor balance of £50 at the end of, in this instance, let's say it's the end of the month. So the brought forward debtor, the start of the month debtor, was a debit balance of 150, and at the end of the month, it was a debtor balance of 50. This carry forward 50 is the opposite of whatever the balance is, because it's the net of it. You can see here £800 worth of debit balances, £750 worth of credit balances, so it must be £50 worth of debit balances left. That there balances up, so you can and it's only because at the end of each period, whatever it is that we have, we add up our debtors and our creditors within credit balances within the T account, and we just make sure that they equal the same. That's the balancing figure. The balancing figure, the opposite side of the balancing figure, is what it will be brought forward in the following month or the following period. So we have a debtor balance. We're owed £50 in this case. Right. So we've now got something called aged debts within our book, and it's suggesting to us then that we need to using an aged trade receivables analysis, and it's on page 51 in here. And you can see on page 51 it separates out a series of balances within the sales ledger into days, into sort of how long each debt's required. So why do we do this? Why do we separate our sales ledger, the separate thing that we have off our general ledger, into this sort of aged analysis? What's going on here, and why do we go to that effort? Well, if you remember, I've got this idea of professional skepticism going on. I've got this sort of 61 days plus debtor from Adams Limited. Now actually in that instance I've been analysing that out. Is it 61 days? Is it 90 days? Is it 120 days? Is it 250 days? I don't know. How many days has Adams Limited been outstanding? Because I've got a professional skepticism going on once I get past sort of certainly 60 days of thinking, is this debt recoverable? Is this company in administration? Is something going wrong? I'd certainly want to stop them getting any more supplies from us. We're not giving them any more credit for that. Because they're not paid us. On the alternative, there might be nothing wrong with their company. Their company might be fine. It might be us who've made a mistake. They might be in dispute with us. They might not be wanting to pay because they think our goods were faulty. They might not be of the view that they received the goods. They might be of the view that they sent the goods back and somebody nicked them whilst they were on the van. All these kind of things that happen, where on the one hand it might be that there's something wrong with them. Alternatively, it might be that there's something wrong with us. As a professional accountant, you're just looking at it and considering, can these debts be recovered? And then actions that have to be taken from that. So that's why we have age analysis. Also as well, if we go back to chapter 3, and we had this concept, and we're going to pay later, but we're not going to pay late. So we are playing a bit of a game, really. Your debtors clerk, your debtors person who's claiming the or getting in the debts, versus their cash book person, our cash book person versus their debt recovery person. And this game is who can pay the latest without breaking the rules. Really. So we want to have a look at this as well, because okay, Adams Limited is over 61 days, and we have a problem about the recovery of that debt. But T. Brewster and D. Miller are over 30 days. So what's going on with those two on page 51? That they're playing the game a little bit more aggressively than we would like to. Let's say our terms were 30 days. So we would only give them 30 days credit, but they're taking more than that. Now, is it 31 or 32 days, or is it 60 days, and they're taking the mickey out of us? And so we need to we then go through and we chase those up. If we just had a look at a general overall picture, and we were just looking at a control analysis and thinking, actually, we're just looking at the bottom line figures and going, well, that's a lot above that, not a lot in between 0 and 30 days. That's just 2,710. 2,220 is a bit unfair, and 3,510 is a problem, and just went across everybody without making any kind of distinction between individuals, and just was chasing down the whole lot of our suppliers aggressively. Well, Harrison and Co. and T. Brewster might be thinking that there's something wrong with us. So a more aggressive, just a general aggressive approach without the sales ledger, and without the sales ledger split down into the aged debtors analysis, would mean that you would both waste your effort chasing certain debtors, but also as well you would be flagging that your company's in trouble when it's not. So that's why we break down into this aged debtors analysis in here. If I was looking at this, and what I would sort of say is Adams Limited is a problem, now though, probably in terms of their recoverability. T. Brewster, it looks an odd amount to be over the 31 days, 36 days. That might actually be a mistake within our system, really, in terms of actually, was there some kind of discount that they were offered? Did they not get the goods requirement? But that seems oddly low compared to the 0 to 30 days. And D. Miller is probably taking the mickey out of us, and we need to chase them up. So that's why we have that kind of information there, to be able to sort of look and make some actions about what we're going to do. Now, we also then have the purchase ledger control account. So I'm going to do the same diagram again. So I've got the purchase daybook, and I'm going to skip to page 57. I'm going to follow that through for you. So we've got the general ledger account coming off there again, and in there we've got our purchase ledger control account. So we've got our control account sitting in the general ledger. Remember? And the total amount from the purchase daybook goes in as the credit now. And it's the amount that we owe, which is a liability. It's increasing, so it's a credit. We've got the VAT control account. And we paid, or we owe £120 worth of VAT. Oh, well, we owe £120 to our supplier, or suppliers in this case, of which £120 of it is VAT which we can recover. So it's an asset that's increasing is a debit. And we have the purchases account within the profit and loss account, and that is a debit of £480. I think at level 2, this though, just to come back and reiterate, I think you're putting that down as your equity account at this level. At level 3, when you start to do the profit and loss account, the statements of accounts, you're going to start to produce these purchase accounts. And then the individual items are going off into the purchase ledger. So again, we've got our general ledger with our double entry bookkeeping, 600 credits, 600 of debits, together in our double entry bookkeeping. But then we have our purchase ledger over here, and our purchase daybook goes in as individual items into here. So, and again, we can now reconcile our purchase ledger with our purchase ledger control account, and they're the same. So we know everything's hunky-dory in terms of what we posted. Aged trade payables then. So that's what we've now got, this purchase ledger, and we've got some aged trade payables in here. So this is on page 58. Why would we do that? Well, again, I come back to this idea that we're playing a game, aren't we? We're trying to pay later but not late. So we want all the terms of our suppliers all put into this sales ledger. So actually alongside in the sales ledger, what you would tend to see would be supplier X, and you would also have some field often which would set out what their terms were. So it might have 30 days here, it might have 15 days here, whatever it would be. So these terms would have been put in as well. And so we would have a download from our system, or a comparison from our system, and it would provide another age analysis of our trade payables, and we would look at when we're going to pay them, because that will allow us to pay later but not late. So there's the principle which we saw in chapter 3, to pay later not late. It might have been in chapter 2, sorry. But how do we achieve it in reality? We achieve it in reality through a trade payables analysis, because there's no good having a principle but not being able to achieve it. So that's how we achieve it. Now, on page 60 then, we have this idea of set-off and contra items. So why is it that we have this sort of thing where we've got two amounts owed in here, A. Smith in the sales ledger. So A. Smith owes us £200, but we owe A. Smith in the purchase ledger £300. Why don't we just pay A. Smith £300 and then wait for A. Smith to pay us £200? Well, we're going to be professionally skeptical here, and we're going to say, why on earth would we pay A. Smith £300 when we know that they owe us £200? Let's say we paid A. Smith the £300, but then A. Smith turns around to us and says, well, actually, I thought your goods for the £200 weren't very good, so I'm not going to pay for it. Well, we've suddenly lost all of our negotiating position, because we could have told A. Smith, well, that's okay, because we're only going to give you £100 anyway, and you can dispute it as long as you want. So we have this first idea of the potential for disputes. Well, why would we pay A. Smith £300 and still wait for the £200 when A. Smith could go bankrupt in the meantime and we couldn't get the £200 back? Or alternatively, A. Smith might just simply run off with our £300 and forget about the £200. So we're not going to pay where we owe somebody in the sales ledger, or where somebody owes us in the sales ledger, but we owe them in the purchase ledger. We will be setting off their sales ledger against their purchase ledger first, and then paying any amounts due. And we'll try and chase the full amount in the sales ledger, because we'd always want to try and get the money in our bank account before theirs. But typically they'll try and do this set off at the same time on their side if they ultimately owe us something there. So, well, how do we then achieve that? Because we can't. We still have. If we go back to this initial concept, don't we, where we got these various day books. And all of this information, well, these various day books that we posted, these various control accounts, these various individuals, and they're all there split up so that different individuals in our finance department are chasing individual parts of them. If we don't make an adjustment to the sales ledger and to the purchase ledger, the individual different people, so there are different people who are doing this sales ledger, who are managing this sales ledger, and different people who are managing this purchase ledger. The sales ledger person will still chase £200. The purchase ledger person will be thinking, oh, I'll pay £300. So unless we actually put in a contra item to delete out the 200 and also to delete 300 off the 200 and effectively post that as a journal, a debit of £200 to the purchase ledger of A. Smith and a credit of £200 to the sales ledger of A. Smith, unless we post that in there as a contra item, then those individual people will still just follow the initial amounts that they were going to post. And as we set out earlier, that wasn't necessarily a good position for ourselves. So that's what a contra item is where we set them off. Now, will they be set off in the general ledger? And actually the position is, if I put them in here, now I think I put them in. I put off this set off item because I think it was actually in the amounts. So let me just check. It is. So on page 48, it's actually in there as a set off contra item in the sales ledger control account. Now, that actually, and this is at professional level, that is not allowed within accountancy. That is set off in there, and you're not allowed to set off within a set of financial statements. So it shouldn't be in there. But for some reason it is in there at AAT, so it's put in there. But when you're then doing it in your professional levels, if you go on to that, you'll be told that you're not allowed to do set-offs, because what it does is it manipulates the financial statements and reduces, in this instance, the debtors figure and the creditors figure to a figure that's lower than they really are, and it's not true and fair in terms of the accounts. So it's in there, and so I've put it in. I've explained that it's not actually correct, but that's at professional level, sort of levels 4, 5, well, probably levels 5, 6, and 7, where so you don't need to worry about that at this point. So we've done another run through then of our purchase day books. Again, we can see we have our general ledger here with our double entry bookkeeping. We have our separate suppliers ledgers here. This nicely then allows us to total that lot against that. And we've got our trade analysis, and we've got our contra items. Now what I'm going to do before I go into the VAT control account is I'm now going to come back here. And I'm going to now show you how this gives us a big figure that we can compare for. Let's say now Supplier X gives us a reminder, and Supplier X tells us, just to remind you, you owe us £120. So they send us in another financial document, and it tells us that we owe them £120. And we look in our sales ledger, in our purchase ledger, and we find that it's only £100. We can now investigate that. And we can go back to Supplier X and say, no, actually, we don't owe you £120. We paid you this. And this is there's a lot of this that goes on. And you have to really be on top of this in your finance department, because errors get made all the time in other people's finance departments as well as in your own. So let's say that Supplier X sent us in this reminder, and we just paid them from the cashback £120. So we put £120 in the debit figure in here. And now they owe us £20. We are never going to get that £20 back, because probably it was a question that we were disputing the value of their order. They sent us goods that were faulty, and we think that we're not going to pay for that £20 worth of it. Well, if we paid for it, we now good luck chasing and getting that £20 back. So we're always then going to be comparing our reminder notices in the same way as those people. We get a remittance advice, and customer X pays us £80. Now we need to chase up customer X and say, well, actually, hang on a second, you owe us a further £20. And if we do not do it right away, so we leave this now 3 or 4 months, and we're now going to chase this £20, that's not going to be recoverable. They won't pay that £20 in 3 or 4 months. We actually have to chase them up straight away on that. There will be excuses like, well, I've closed my accounts now. Our budgets have ended for the year. Know that the claims that you were supposed to make have run out of time. That kind of thing, so that they might owe you £20, but you'll never recover it, and therefore you'll have to write it off, and that will be a write-off expense. So these ledgers here, those remittance advices, those reminders as well, supplier notice reminders, they're no use for the control account, because comparing customer X's, in this instance, let's say £80 into that, no use at all, because it's comparing 80 against 600, and there's a whole series of other customers in there. It doesn't break it down for you. You have to be able to compare into these ledgers. This is why the separate ledgers appear, and it allows the timeliness of the action. We can do it when it needs to be done, which is straight away, so that then we got more chance of getting that money back in. And that's why the two sets of information exist as well. Okay. The VAT control account. So we had on our general ledger, we had this VAT control account, and I've got one here for you. So I'm going to bring forward a figure. So let's say we're a VAT return is done every 3 months. So we've gone past month 1, let's say, and we owed HM Customer Excise £150 for the last month. We're not going to make that payment yet, because we've still got another couple of months to go. What else now is going to go into this control account? Well, the purchase day book. So we bought £600, we bought some purchases, and on that was £600 worth of VAT. That's an asset to us, because the HM's Customer Excise will pay us that back. So an asset that's increasing is a debit, so £600 there. But we sent some purchases back, so that would be a credit, because we wouldn't actually when we sent that back, we then no longer had the asset on that that VAT on the assets or the goods that we sent back. We then got a sales daybook, so we made some sales and we owe H&M's Custom Excise £600 on those sales. Something that we owe, a liability that's increasing, is a credit, so £600. But they brought they bought some of their goods back, and the VAT on the goods that they brought back was £50, so that was a debit. We had some discounts allowed, so we made these purchases. We made these sales, but then we decided that we would give people discounts against those sales if they paid early, and the VAT on those discounts allowed was £50. But similarly, we had some discounts received. They came in from the discounts received daybook, and the value of the VAT on those discounts received was 100, so that was a credit. The cash book. Now, I sort of the diagram. I think you separate you put the cash book in like that together as one thing. So I put the cash book in there. So we have purchases that we made for cash. We have sales that were made for cash, and there's the VAT on both of those coming in. So we can see how all of these books of prime entry have all gone then into this general ledger control account. Now I do the way in which I like to do it, which is total this up, then I'll work out what the difference is, which is the carry forward in here. So the difference between the 1,900 and the 1,200 is 700, and then I retotal them as well. So that is an extra line that's in there for me compared to what you see in the books, just simply because it's more foolproof. It will stand up more in the exam. And the opposite of the carry forward is the brought forward, or the brought opposite. The carry down is the brought down, the same thing. Yeah, and that is the credit balance in the general ledger. So we owe H&M Custom Excise £700 at the end of the month. At the start of the month, we owe them 150. At the end of it, we owe them 170. So that's the VAT control account. We'll do journal posting in the next chapter in more detail anyway. Now that is then the end of this chapter. It has the additional stuff at the end where it's explaining the purposes of the control account as the AT management. I did them at the start, but just to recall, it's designed to try and improve what I sort of say is the relevance and comparability of information. So we've got this information in a more effective manner, both in terms of the total figure in the control account, but also in the underlying split in the ledgers. Now it says instant information here, so I gave you an idea of that as being of timeliness really, that on the one hand we would not have to add up the balances of all the subsidiary accounts, which is there, so it's timely, it's faster, but also I'm going to say as well that it gives you a faster way of checking for errors as well. Now in this error checking, I want you to imagine something, and I want you to go back. Let's go all the way back to here. This purchase ledger, and let's now say that there's 1,000 suppliers that we work with, and it's a haystack of information, and into there we're going to throw our needle of an error into this massive haystack of 1,000 suppliers, and I swirl you around a little bit, and now you've got to go and find it. So you've got to go and find this error in 1,000 suppliers, and that will be the equivalent of throwing your error into your control account. What if I instead split up your haystack into 1,000 separate boxes, and I told you that the needle was sitting in box 566, of which within those boxes. So you go out and take out supplier 566, and this box. You empty the hay out of that, and you find the needle. There's a little bit of sifting, not a lot, in there. So basically what this is trying to do in terms of the control account, but also the separate ledgers, from an error point of view, splits that haystack up into the individual boxes that you can then go and find your needle in. It's entirely possible as well that you may get an external financial document that will tell you where your needle is in your errors. And I'll sort of say this limitation of control accounts here. It says whilst control accounts can help in locating errors, they do have a limitation that all errors was shown. For example, if a transaction is entered into the wrong trade receivable subsidiary account within the sales ledger, it will not be revealed when the control account is reconciled. Yes, it won't be revealed when the control account is done. So let's say we put an error and we posted supplier X into supplier Y. It won't be done or noted there when we reconcile this figure to these figures. However, it will be noted when supplier X chases us for £100 and they tell us you owe us £100. So we've got this and we compare here. We then go back through it and we find, oh, we posted that incorrectly and supplier Y owes us £100 because we overpaid them. So it won't do it initially or immediately. It will do it. The control account combined with the ledgers and reconciled up together so that we why do we reconcile here? We reconcile this to this because it gives us faith that these balances, at least they balance to a figure that we know is right or we think is right, so that when something else comes in and we're comparing to this here, an external financial document coming in from outside, at least we have some faith that we're starting to compare from a sensible basis, that this isn't a load of rubbish. So it does have a limitation there, but combined with a ledger, in this case the purchase ledger, it will allow you to fix that. So and in terms of the prevention of fraud, well, particularly in the manual accounting system, I mean, I'm not quite sure why it would be a manual over an electronic one, because essentially all the difference between a manual one and an electronic one is the manual one had a series of books that the individual person held the book in their hand, and the electronic one has a series of books or journals where the password permissions allow them to post to particular areas. So the same kind of thing, really. They allow the prevention of fraud because they allow you to split up the posting of the cash book, let's say, into the purchase ledger control account and into the individual amounts, the chasing of the individual amounts or the payments by another person. So this posting, there's a purchase day book, let's say, will be posted by one person into here. The cash book will be posted by another person into here. The cash bank reconciliation will be done by another person against the cash book. The purchase ledger control account reconciliation against the suppliers will be done by another person. The key one here would be if we were in, let's say, the sales control account, where our debtors clerk may decide to give a discount allowed, let's say, or a credit note to somebody in order to, let's say that I'll reduce your amount that you owe us by £2,000 if you give me £500 worth of it. If we have these control accounts split up, so the one person's reconciling the control account against the underlying sales ledger, which was prepared by another person, and also another person is comparing the sales or the supplier notices, reminders against the sales ledger, then that's not possible, because it will very quickly become evident that somebody's attempted to commit fraud. This person here, in this instance, our debtors clerk. And this idea of splitting these control accounts with these separate ledgers, individual people posting the day books, and individual people chasing up these individual amounts or paying these individual amounts, so it's all different, means that no one person maintains control, and no one person can therefore commit a successful fraud. And that's the point. Now, frauds do happen, but mainly they are because control accounts aren't reconciled properly. And I think that's it. So let's now do some questions, shall we? So let's go through 4.1 then. You have the following information: opening balances at the start of the month. So we're in a sales control account here. Opening balances at the start of the month, 18,600. Credit sales for the month, so debit amount, and there will be 9,100. Sales returns for the month, 800, which will be a credit amount. So in total, that's going to be a debit figure at the end of it of £26,900. Prepare a sales control account for the month of June 2017 using the following information. Balance brought down, so that's going to be on the debit side, 17,491. Credit sales for the month. So it's credit sales, it's not cash sales, so it's going to be a debit balance, 42,591. Sales returned from credit customers, so that's going to be 1,045, and that's going to be a credit balance, they owe us less money. Money received from credit customers, so that's going to be debit cash, or debit the bank, credit the sales ledger control account, £39,204. So the balance in the account at the 30th of June is going to be debit balance £20,013. Right, okay. You work as an accounts assistant for Shire Traders. Today you're working on the sales ledger. The summary transactions are shown below. Let's go down to the bottom bit there. It's got this balance of the customer account, so the brought forward balance, which we find first always, £180,824. Goods sold on credit, so that's going to be things that people owe us. So it's an asset, it's going up, it's a debit. So that's £118,000 and it's £118,600 as a debit balance. Money received from credit customers, so things that they've paid off their assets, so that's going to be reducing our assets, so that's going to be a credit balance, so that's going to be 96,214 as a credit balance. Discounts allowed, so money that people don't owe us, so that's an asset that's going down, so that's a credit balance, so that's £300 credit. Goods returned by credit customers, so they're giving us money, goods back, so they don't owe us, so that's an asset going down, so that's a credit balance of 650. An irrecoverable debt written off, so we can't get this debt back, so that's an asset going down, so that's a credit balance, so that's 350. So the balance there carried down or carried forward to the following month is going to be a debit balance of £201,910. Okay, so that's that one. Now, it says that the following account balance is in the sales ledger of 30th of June, and it has the list of them, and that totals £202,260. So we reconcile the amounts that the balance there, so we've got a comparison there. So we've got £201,000 and £910 in the sales ledger control balance, and we've got £202,260 in the sales ledger account, and so the difference is £350. What might have caused the difference? And so looking at it, it's got the irrecoverable debt written off, which is the same figure, and that looks like Brandon Limited. So that's what you would say, it would be the irrecoverable debt written off. Now, remember earlier on I said that in real life the book's not right here, and if this is what's the AAT account as well, the AAT exam as well, then the AAT exam isn't right either. In reality, you would keep Brandon Limited in your sales ledger account. And the £350 doesn't go into the sales ledger control account, it goes into the provisions for bad debts account, because you still want to come back and be able to check that Brandon Limited does not attempt to go and try and buy anything from you again, or any of the ex-directors of Brandon Limited, or anybody connected with Brandon Limited, because you know that they're going to, whatever you give them, they're just simply going to steal from you. Well, it's not stealing, I suppose, it's going bankrupt, but still it's the same kind of thing, you won't get the money back. So actually, the company was correct here. What there would have been in the general ledger would be the irrecoverable debts written off wouldn't have gone into the sales ledger control account, it would have gone into the provisions for bad debt. However, this is the exam, so this is what we're going to put in, and we're going to put in that, and we're going to explain that it's the £350 irrecoverable debt written off. Okay, so let's do 4.4 then. You work as an accounts assistant. Show us whether they're a debit or credit item in the sales ledger control account. Now I'm going to talk through these ones then. So balance of credit customers at the September. So it's an asset that we own. So let's say that it's an asset. So that's going to be a debit. Goods sold to credit customers. So that's they owe us. So that's an asset. An asset that's increasing, debit balance. Money received from credit customers. So they were an asset. They've paid their asset off, so that asset's going down, so that's going to be a credit balance. Goods returned by credit customers, so they did owe us money, but they returned their goods, so it's an asset going down, so it's a credit balance. Discounts allowed, well they owed us money, but they don't anymore because it's an asset, so it's an asset going down, so it's a credit balance. Irrecoverable debt written off, it's something that was previously an asset, it's now worthless, so it's an asset that's gone down, so that's a credit balance. Right. What will be the balance of the credit customers on the above account? Well, I'll add up the debits and the credits, and the difference is, I think the balance brought forward into the following month is £45,195. Right, the balance totaled 447,878. Well, the difference there then is £467. Okay. Identify the difference. Two of the reasons which might have caused the difference. Discounts allowed have been understated in the sales ledger. Well, right, okay, so discounts allowed have been understated. So it's saying that I think it should be 400. So I think that the asset in the general ledger is higher than what's in the sales ledger, right? So discounts allowed have been understated in the sales ledger. That's not true because the sales ledger would have to be higher than the general ledger for that one to be true. Goods returned have been understated in the sales ledger. That's not true either, because the sales ledger would have to be higher than the control account for that one to be right. An irrecoverable debt has been omitted from the sales ledger. No, that's not true either. If it had been omitted from the sales ledger would be higher than the control account, so that one can't be true. Money received from customers has been overstated in the sales ledger. That could be true, because the sales ledger would be lower than the control account if that was the case. Sales to credit customers has been overstated in the sales ledger. That can't be true because that would have the sales ledger being higher than the control account, so that's not true. Sales to credit customers have been understated. Well, that must be true because that's got sales in the sales ledger being lower than the control account. Trade discounts has not been included in the sales ledger. Well, that would be no, that would have the sales ledger being higher than the control account, so that can't be true. So the answer is D and F. I think that's enough reason. Right, okay. All right. Oh, so we've got an age analysis one. Let's do 4.5 then. What would I do? For each of the accounts listed above, what actions are we going to take? So we've got no actions, we've got letters and emails, and we've got letters and a phone call. Right, okay. Now this would really be about what your level of aggression would be, actually, if I'm being truthful here. And really, the difference between 30, our trades. Right, so our terms are 30 days. So anybody over 30 days is cheating. So anybody less than 30 days, they're fine. So Charterist is getting no action. There. Well, actually, yeah. So Charterist is getting no action. That's fine. Right, people between now we've got 30 days to 31 to 60 days. This now depends on your level of aggression. I think this actually is too open as a thing. Actually, we probably would be phoning up everybody over the 60 days, and that would simply because you would get your money back faster. And going into the concept of it's better in our bank account than in somebody else's. Chapter 2 would be saying do everybody over 31 days. Let's check what the answer actually says, because I'm getting a feeling that it's not going to say that. Let me check. Yeah, so all it's saying really for Ben Limited is they're over the 30 days, but it's £1,800 over the 30 days, but we're just going to give them a letter or an email. Honestly, I'm not overly sure on that one, really. And B. Morgan, who has £180 or £120 over 30 days, gets no action at all. That's not what would happen in reality. In reality, we were lettering and emailing there. I think this is too open a question to be able to actually have an exam question on the basis of that. What you would actually do in reality on Ben Limited is you would check the thing, because the difference between 31, 32 or 33 days is very different between 57, 58, 59 days or 60 days. And if Ben Limited was at 57, 58, 59 or 60 days, we would be sending them a letter. The 60 days plus here, though, is a weakness within this age analysis thing from Wilson's and so from a letter or an email or a phone call. It could be 61 days. It could be 561 days. We could be taking severe action against them if they were, let's say, over 180 days. Or if there were 61 days, yeah, we'd be folding them up. Actually, in an age analysis, this would be split and would have even more and that more split out there. Not the greatest of questions really there, to be honest. I don't think you would have really been put under any kind of pressure either to get those particular answers. Yeah, so that's those questions. The rest of it all looks like the same of what we've gone through really. So don't think there's anything new in any of the rest of it. Feel free to keep calculating. Let's have a yeah, it's all the same kind of stuff. So let's just have a quick check of the last question. Sorry, I thought I saw something on VAT there. Where's it gone? Well, there's a VAT return in here. And so you can you're just preparing a VAT control account and then comparing it to the VAT return, seeing whether they're the same. And you can see how here we have a VAT control account that lots of different people have been posting into, and then we have a different person producing a VAT return and seeing whether they're the same by comparing them to the control account and checking whether the return is correct. So let's just go through and see what it is that we've got here. So if I put the items in from each of the sales, alright, so we've got the sales day book in here, so the VAT would be a credit there, the purchase day book, the VAT would be a debit, the sales return day book, well, that would be a debit, the purchase return day book, that would be a credit, the cash book cash sales would be a credit because we would owe that. So those added up would give us a balance that we would owe of 6,992. The accounts assistant says 7280, so there's a difference there, and the difference is what's that there? The difference is, you just add that up. 7280 minus 6992, 288. So that looks like the sales return day book hasn't been posted or hasn't been included within the VAT return. So the accounts assistant who's been producing the VAT return didn't pull that day book into or didn't consider that when they were preparing the VAT return and was going to pay HM Custom and Excise too much. Oh yeah, there we go. That's the right answer. That's good. Right. That was an hour and 12 minutes. Hope that's been useful. I think it should be to make this this one a more sensible thing. Sorry it took so long, but it is quite detailed, and I'll see you in the next chapter. Bye.